Hey guys, it's Willie. Today I want to take a look at Dell Technology stock. You know, Dell, the people who make the computers and printers and computer monitors. Yeah, those people. Let's take a look at their stock year to date. You're looking at 4.7% up. Over the past 12 months, you're looking at 48.42% up. That's a huge run up. Especially for a boring company like Dell. But I want to take a look at the financials today and see how much of a value play we think this might be. And spoiler alert, I think you're going to be delighted by how much of a value play this one is and how good it might be. So let's switch over to our spreadsheet and see what we can figure out. Alright, so now that we're in our spreadsheet, I want to first start with, the money the company brings in. So starting with revenue. Unfortunately, we can't go back the full 10 years. However, we can go back the past 8, which, I can live with. You're seeing really good growth from Dell in terms of revenue, 21% over the past 8 years, 21% per year over the past 8 years. Net income is a bit more dicey. We've seen about 2 years of profitability from Dell, which is really strange. I thought they were a older company than they are, and they would be profitable. But we've only seen 2 years. I thought that was strange. But let's assume that this profitability is going to continue from here on out. I think that would be the best case scenario for Dell. I think with revenue growing and all the other things growing in the right direction, I think they should remain profitable, and I think we'll be okay. Cash flow from operations, you're seeing good growth. After we subtract our capex, we get our free cash flow. Free cash flow is growing at about 24% a year over the past 9 years, which is a bit large given you're starting at 1 billion and ending at 9. So I looked here in this area where you're going from 5 to 9 billion. You're looking at roughly 15 to 20% a year, I think it was. I think that's what I figured up. So still seeing really solid free cash flow growth from Dell. So earnings and free cash flow going up. Like to see that. Shares, unfortunately, they are growing. Right in here, there was a big jump of about, 280 million shares. There was probably an acquisition or something in there, I'm sure. I think we could probably go on to expect that there will be an issuance of shares like the rate we've seen over the past 4 years, not this big jump that we saw. So a slow rate of issuing shares. Not a major concern since it's low, but I'd rather not see the shares growing as much. I wouldn't want them to grow at all, but it is what it is. Taking our earnings and dividing it by the number of shares, we've seen the negative numbers like we saw in the net income. We've seen 2 years, just like the net income, of the positive earnings per share. I think we should operate on the assumption that this profitability is going to continue. Free cash flow, we keep those positive numbers all the way through. Good growth. About 7% a year over the past, 8 years again? Yeah. So moving on to debt. Debt has grown quite a bit. Again, right in here you see a big issuance of debt. I would assume there's an acquisition along with the shares going up. There's probably something going on. That would be something to look into. But, we're seeing this slow growth rate. I think we should expect that to continue. Subtracting our cash out, we get our net debt, which compared to the free cash flow is a bit high. You're looking at, what would that be? 100 times? So not really great compared to the free cash flow. So I'm concerned about the debt. that would be one thing to look into to say, okay, what does the debt look like? And is that at a manageable level? Let me switch right quick. I'm gonna do some on-the-fly research, if you don't mind. I'm gonna go to my software, and I'm going to well, not software. It's the website that I use, and I'm gonna take a glance at their assets, total assets. Okay, so you're seeing total assets are higher than the amount of total debt. I'll bring it back over. Maximize, here you go. Total assets in 2021 was $123 billion. But yeah, that's $123 billion. So, it may be okay, but again, I don't get into the asset thing because of how they've got things on their balance sheet, may be different from the price that they could get for it. Moving on to return on invested capital, I'm going to completely ignore that because none of those numbers make any sense, especially a negative almost 4,000% ROIC. So I'm going to assume that there was something, I don't know what, something went wrong with the calculation of that number, or I don't know what happened, so I'm going to ignore it and move on. Onto our metrics, our PE is saying that it's cheap. Based on our 5-year earnings, you're seeing really high just because you've only seen 2 years of profitability in terms of net income. Price to free cash flow, you're seeing single digits. That's looking really cheap. Debt, again, that's really high. I would look into that, make sure that Dell can manage that. Revenue growth, good. Earnings growth, since you're going from a negative number to a positive number, that is technically an infinite rate of return, so you're getting an error message there, but let's assume profitability continues. Free cash flow over the past 5 years, really good growth, probably because of the acquisition that I think happened. You're seeing positive growth in shares outstanding, but it's only 2% a year, so I'll give them a pass on that. Return on invested capital, we're going to ignore it because it doesn't make any sense. But if we come down here and look, so we take our free cash flow and our net income and we forecast it forward. I'm assuming a 5% growth rate for free cash flow, 12 multiple. The only reason I'm going so low with all of these is because of the uncertainty in the profitability, the net income only being positive for the past 2 years. I want to be extra conservative with this, as well as the debt level. I just want to be super conservative. So free cash flow 5%, 12 multiple gives us $237 in 10 years. Our net income forecast growing at 5%. I said 12 multiple for that too. 82.83 price target in 10 years. I'll adjust these numbers shortly so they're not so conservative, so you can get a good idea of what we're looking at if you think growth prospects are higher. But moving on, $60 is roughly what it's at right now. We average our two prices and see there's a large discrepancy between the two. I think that lends itself to the uncertainty that I have about the stock price. But 160, you're looking at a 10 years average, those two together. So you're in at 60, you get the cash flows, you're out at 160. That's a 37% return a year. That is one of the largest ones I've looked at thus far. The only one that I can think of that probably came close to that would have been either Intel or Alibaba. I don't think either of them got that high. No, I don't think. I'd have to go back and look, but I don't think so. But nonetheless, this is a very attractive rate of return. If we come back and see right in, where was I talking about? Right in here, there was a roughly 15% free cash flow growth rate going on. So if we come down here and go a bit more aggressive and say, well, what if they grow free cash flow and net income at 10% a year? And since they're growing at 10%, they should have a higher multiple there, shouldn't they? Of course they should. So you get 473 in 10 years with the free cash flow and 164 net income. Come over here, average the two, you get 318, almost 319. You're looking at a 47% annualized rate of return over the next 10 years, which is phenomenal. I don't really know what to say other than this would take some more research. I think some of the numbers that I was pulling up don't make a whole lot of sense, especially the return on invested capital. That's a little odd. The net income only having 2 years of positive numbers. That's kind of weird. Not sure about that. What happened in here that made free cash flow jump? What made CapEx jump? What made shares jump here before the free cash flow and CapEx went up? Those are some questions. And the debt level, I'd be wondering about it too. But yeah, I think this is a really good stock that would be worth looking into. Really interesting, really good possible rate of return that we'd be seeing. So, yeah, as always, do your own due diligence, do your own research, look into all of those weird things I just talked about. And with that, I will end the video here, and I will catch you guys in the next one.